Can I start off by saying either good morning or even a good afternoon or even a good evening, depending on where you are around the world. And thank you and welcome for joining me tonight on the latest webinar episode for Stratton Markets. Tonight's episode is called How I Started to Learn About Bollinger Bands and the RSI. This is maybe an introduction on these two. Written by myself, of course, which is James Truskothick, and I'm the head of investment research here at Stratton Markets. Now, before we get moving on tonight's agenda, and of course, a little introduction on myself, bear in mind we are talking about online trading and CFD trading, and like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your due diligence and know the risks at hand before entering any trade. With that out of the way, this black and white, rather stylish picture, looks a bit like a boy band member, is myself. Like I said, my name is James Truskothick, and I'm the head of investment research here at Stratton Markets. I have over 20 years experience in the financial service industry. I'm also a published writer, and I've been published in several leading industry publications. I'm an avid market commentator, extremely passionate about this market, and I'm a well-known public speaker. Now, tonight's agenda, like I say, is an introduction into Bollinger Bands and the RSI. I'll do a lot more in-depth episode later down the line for your education. Now, on the agenda, first of all, I'll discuss what is technical analysis. Then I'll discuss technical analysis versus fundamental analysis. Then I'll discuss the theory behind using technical analysis in trading. Then an introduction into Bollinger Bands and an introduction into the RSI and how we can see if the market is potentially overbought or oversold. Then we'll discuss the other up-and-coming educational events for the remainder of June. So what is technical analysis? Technical analysis is a method of trying to establish potential future direction of an asset by studying past price data and volume. Now, obviously, the other type of analysis is fundamental. So let's compare the two. Fundamental analysis is a method of analysis to try and identify the intrinsic value of an asset. Fundamental analysis studies the overall picture by taking into account economic, industrial, and financial conditions. Technical analysis, on the other hand, assumes that fundamentals are already factored into the value of an asset, so it ignores the intrinsic value altogether. Instead, it tries to recognize patterns and trends to try and predict future movements of an asset. Now, the theory behind technical analysis is that previous trading activity can give a lot better indication of what direction an asset may go. The basic concept was developed by the Dow Theory, written, surprisingly, very creatively, by a chap or individual called Charles Dow. The Dow Theory believes that price movement is not random, but follows patterns and repeating trends. So when traders try and use technical analysis, they use what's known as technical indicators. And technical indicators are the following. Technical indicators are calculations that take into account price, volume, and demand over a period of time. Examples of this include the relative strength index, which we'll do an introduction on today, stochastics, MACD, moving average convergence divergence, Bollinger Bands, which again we'll do an introduction on today, trend lines, simple moving averages, and the commodity channel index. Let's go into Bollinger Bands first. Now, Bollinger Bands was developed again by a very creative name, by a chap called John Bollinger in the 1980s. Now, traders tend to use Bollinger Bands to measure market volatility. The theory is that whenever the bands are wide apart, there's a lot of volatility. in the market. And when they are closer together, the market is quieter. Bollinger Bands consist of a moving average, and traders also use Bollinger Bands to try and identify potential support and resistance levels. And I'll explain them how they do this. Here's an example. So we have our upper band. Let me get my pen here. We have the upper band, the middle band, which is the moving average, and the bottom band. The theory is when the bands are wide apart, like here, it's very volatile in the market. However, when the upper band and the lower band are closer together, it's not so volatile, which means the market is ranging. And this is when traders look for, because the theory is the bottom band acts as a support, i.e. the market will jump in and start buying the asset. So that's a good idea to buy from. And the upper band will act like a resistance where the market will start selling from, and that could be the level where to sell from. Let's have a look. Bands are wide apart, very volatile, so we're not interested at this point. We're interested when the bands get narrower, and let's have a look, see if it works. Touches the bottom band, market starts to buy in again. Touches the bottom band here, market buys in again. Touches the upper band, market sells off, so starts selling off. Touches the bottom band, market jumps in, starts to buy in again. Market touches the top band, market sells off, market asset starts to drop, etc., etc. Now the RSI. Like I say, this is purely an introduction. We'll do a lot more in-depth episode later down the line. Now, the relative strength index, and it's infamous actually, it's incredibly famous, is a momentum indicator, which many believe can be used to ascertain if the asset is overbought or oversold. Now, the RSI has a value range between 0 and 100. The theory is that if the value is above 70, the asset is potentially overbought, which could cause a sell-off. And if the value drops below 30, the asset is potentially oversold, which could encourage the market to start to buy in again. So here we go. Here's our RSI, sorry. So we have our 100, our 70 level here, and our 30 level here. So remember, if it's around the 70, it's overbought, the market can start to sell off. If it's around the 30, it's oversold, the market can start to buy in again. Around the 30 level, what happens? The market starts to buy in again, pushing the asset higher, which is the 70 level, indicating potentially overbought. What happens? The market starts to sell off again. Hits the 30 level, oversold, market starts to buy in again. Here, mixed signal. Like I say, it doesn't always work. All indicators don't always work. Nothing happens. As you can see, the market range trading. Then it hits the oversold level. Market continues on a downward trajectory, so it doesn't work on this occasion. However, then it then starts to work, hits the 70 level, and the market sells off. 30 here doesn't hit the 30, so it's actually still high, but the market goes up. So again, not giving us a clear indication. Till this point, hits the 70 mark, and the market starts to sell off again. Another example. Hits the 70 level here, market sells off. Hits the 70 level, overbought, market sells off. Hits the 70 level, market sells off. Here hits the 30 level, market doesn't buy in, even though it potentially is indicating is oversold, sorry. Doesn't come in and carries on downward. So again, like I say, sometimes the indicators work, sometimes they don't. Now, up and coming educational events on the 18th of June. The next episode is how I got to understand the important chart patterns. That's a slightly longer one. Then on the 25th of June is how I got to understand pivot points. If you wish to reach out to me or talk to me, by all means, you can email me at james@strattonmarkets.com, or indeed, you can follow me on my Twitter account, which is @JJScothic, where you can direct message me if you wish. Now, remember, I've been talking about online trading and CFD trading, and like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your due diligence and know the risks at hand before entering any trade. So there we go, a nice and short episode tonight. Nice and short. I hope you found it useful and interesting. I'll do a lot more in depth and longer episodes later on the RSI and the Bollinger Bands, but today is just purely an introduction. Till next week, every single one of you have a fantastic day. And no matter wherever you are, either good morning, good afternoon, or good evening, depending on where you are. Until next time, every single one of you, trade safe.